in May of 2022. A lot of us gold-centered sound money folks have been talking about inflation like this for over a decade, right?
Indeed.
And finally, COVID kind of pushed everything into this direction. They kind of, to use a COVID term, quarantined all those dollars a little bit that they printed in the original QE, kept it as excess bank reserves and stuff like that. But this time, man, they flooded it out here in the US and around the world. And now you're just seeing simple supply demand dynamic. I mean, you put out more dollars than there are goods, and those dollars chase the goods and prices go up. And there's really no end in sight. Crude oil, well over $100 again. The grains, important foodstuffs here in the US, all soaring to multi-decade or all-time highs. Nothing that 50 basis points from the Fed can address. You mentioned the everything bubble. And I think that's important for people to understand because, a lot of people phrase it, there was the dot-com bubble and then it burst. And so to re-inflate everything, the Fed made a housing bubble and then it burst. And so then to re-inflate everything, we eventually got this everything bubble. And now everything's going down. It's from a traditional financial planning sense, you're supposed to have stocks and bonds, and your portfolio zigs and zags and yings and yangs. And instead, stocks are down, bonds are down, everything is down, which I guess gives credence to the idea of the everything bubble, right? All right. So then the question becomes, where do we go from here? Going back to about this time, maybe it was June, I think, of 2020, when on my site, the TF Metals report, we first started talking about stagflation being the ultimate outcome of all this. And there's really, I think everybody's kind of caught on that that's the direction that this is headed. And this notion that Powell and the Fed will ever get interest rates, whether it's the one that controlled Fed funds or the bond market, above the rate of inflation, I think is folly. The most analogous period to right now is something we went through just 3.5 years ago. The Fed had played these games, these rhetorical games, for about 5 years, telling everybody they were in quantitative tightening and they were going to normalize interest rates and the balance sheet and all this stuff. And everybody kind of played along until the yield on the 10-year note got to about 3.25% in early October of 18. And the stock market fell 10, 12%. And it kind of stabilized. Everybody started wondering what's going to happen next. And then when it started making new lows in the middle of December, it fell another 10% in about 10 days. And that led to what everybody now calls the Powell pivot. And as we entered 2019, even though we'd had this, crash in the Powell pivot that you can kind of see with hindsight, I guess, the forecasts were still in 19 from Wall Street, 5 more rate hikes, a 10-year note going to 5%, all the same stuff they're telling you today. Okay. But the stock market had crashed, and eventually the Fed had to choose to keep that going, kind of lesser of two evils. They were, okay, we'll go ahead and keep this going, and hopefully the shared prosperity and wealth effect and all that kind of stuff. They'll make that choice again. They have driven every institution, endowment, insurance company, pension fund, private and public, every institution into risk assets through their zero interest rate policy over the last decade. And so if they we're going to be staunch, against inflation, we're going to hike 75 basis points 4 times in a row, or whatever, garbage they're spewing on any given day, they'll crash everything. So they'll take it to a point of max pain like they did, in December of 18, and then they'll reverse. And it is that reverse, that Powell pivot number 2, that's pending. And the last thing I'll add to that, Dave, is when we've seen this in the past, I've been running this website for a dozen years, and I've seen this now 3 or 4 times. It's when the curtain is pulled back and the world kind of collectively, suddenly understands that these central bankers are full of garbage. They're lying to you. And that's when they, just for a moment of time, everybody pays attention to the metals and the miners. And, the trillions of dollars of funds out there kind of flows into our sector. You think back to 2009, QE1 was supposed to be a one-off, right? Never to be happening. Oh, it's just a one-time thing. We're not monetizing anything, said Bernanke. And then in November 2010, here came QE2, and everybody went, whoa, wait a second. And that's when, silver went up 3 times and gold about doubled and all that kind of stuff. Then we got into 16, they were playing the same games. And we had this 8-month period where everything took off. Most importantly, the one period I just mentioned in late 18 and into 19, and gold went from what, 1240 to 2080 from 18 into the middle part of 2020. And we're getting close to, again, that point where the curtain gets pulled back, and that'll come later this year.
That was actually going to be my next question. What's the inflection point? What's the point at which the Federal Reserve say, okay, we can't do this any longer? Do you think it comes later in the year? So do you think there's a couple of more rate hikes in this, or what's going to trigger it? Are we going to see, I don't know, the S&P down further, down around 3,500 or lower, or right? What's the straw that breaks the camel's back?
So that's the level I've been watching, David. Actually, I wrote about it a couple times. I do a public article every month or every week that gets put out, and I wrote about this a couple times back in April. I mean, when Bill Dudley, who was the former head of the New York Fed, so I mean, we're talking, there are a few Fed officials that are a little more important than others. And Dudley, of course, now works for Goldman Sachs. Big shock, right? But he said the Fed's goal was to inflict losses on the stock market to try to generate a reverse wealth effect, where if you feel poorer, it'll cause demand destruction. And if you can take away the demand side of the equation, then maybe prices will come down. Well, if they're telling you they're going to do this, don't fight the Fed, right? So, again, that period that is most analogous is 3 years ago. And in the middle of December, when the stock market took out its previous lows, which were around 2,600 on the S&P, it fell to 2,300 in 10 days. We took out the previous lows of around 4,100 2 weeks ago. And the stock market's been kind of hanging in the balance. On previous occasions, when the Fed has been forced to change, either 16 or 18 or in March of 2020, the S&P fell about almost exactly to its 200-week moving average. If we were to do that again, it'd be about 3,500. A drop to 3,500 in the S&P is another 15% from here. That would be a point that would freak the Fed out enough. So if history is any guide, until the Fed is forced to make that choice, then they're going to continue to play these rhetorical games. And that would be the thing to watch as we go through the summer.
Kind of like a petulant teenager at the moment, because they had been told for a long time, or commentators were saying, inflation's not transitory. This is here to stay. The Fed are behind the curve. They were saying, no, this is gonna go away. This is gonna go away. We're going to see the top of this, and it'll ease back. Well, all of these factors will wash out of the market. They didn't. Then they were faced with having to raise rates, and now they've decided, okay, they're going to tackle inflation. Whatever shred of credibility that they have has been eroded at this stage, and it's going to be utterly destroyed when they're going to have to do a 180 in order to save the US from a recession, which they themselves have created. Where do we go to next after that?
Right. That's that pulling back of the curtain that I was talking about.
Yeah.
Where our sector, nobody pays attention to it. Guys like you and me and, a handful of others around the world. But how many people actually own gold and silver at this point? A couple 100,000? Not very many people. It's all the paper digital assets that people want. And so we are greatly overlooked. And the sector and what moves the price of gold is widely misunderstood. And so every once in a while, though, again, the most recent period being 19 through 2020, people, the greater investment world kind of wakes up to this and goes, wait a second, those gold people, they might be right. The Fed is full of garbage. And that's when they turn their attention to it. And all of a sudden everything, whether it's gold futures, actual physical metal, mining shares, whatever, everything catches a bid. And it's such a small sector that things move, like I said, gold went from 1050 at the lows in 2015, or even in 2018, late 2018 was about 1240. And then it went to 2080. That's 75%. So we could very easily tack on another move. And now from, 1,800, 75% would take you to 3,000. Now you say that and people go, oh yeah, that guy's a lunatic, $3,000. But again, this not like those kind of moves haven't happened before. And so it's that period when the world realizes that that they've been lying to you all along, that they turn that. Now the key will be this time, because it hasn't happened yet, that people finally go, wait a second, they really have been put. They're not. I mean, they're. I'm not going to be fooled the fourth time by this.
Mm-hmm.
And that bid gets sustained. We don't run out of momentum. We don't get people then distracted by, oh, now look, I'm going to put some money over here. Instead, we got people staying in precious metals, continuing to hold precious metals, and then the thing continues to build on it. But we haven't had that crisis of confidence yet. But one thing you said, Dave, I'll point out that, again, I wish I could claim credit for this, but I saw this on Twitter. If you've got to defend your credibility, as these Fed governors, I call them goons, as these Fed goons have been doing, to say, oh, no, yes, we still have plenty of, if you have to tell people you have credibility, you probably don't have any credibility, right? Credibility is just an implied thing. Oh, yes. If you got to remind people that you do, you're on your last legs.
And so we think we're going to see a 180 turn back to quantitative easing. That could come later this year, but that's going to further fuel the already rampant inflation, isn't it?
Right. It's a choice they're going to have to make. Yeah. Powell gets up there and makes it sound like he's a man of the people, right? All these Fed goons do. And they just, oh, well, we know that inflation is such a problem and blah, 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 blah. But their ultimate, employer is too strong of a term, is the financial sector, the banks. So if you're going to rank a hierarchy of needs of what the Powell and Lagarde and everybody else want to preserve and defend, it's the financial sector first, not the average everyday people. If you can drag them along, with this pretend mandate of 2% inflation and full employment, okay. But the third mandate is to keep the plate spinning. Okay, because and even in their minds, they think, well, if the stock market crashes and the economy goes into stagflationary recession, depression, even the people that don't own assets, the regular folks that are renting and just trying to make ends meet, even they will suffer. So they can justify it to themselves to protect the financial sector by saying, well, but this actually helps everybody. And that's what they're, again, because they can't go the other direction. And that's why they'll do it.
Because the other direction is total and utter destruction of the economy.
Right.
But
Exactly.
is it not a case of it's total and utter destruction of the economy quickly, as opposed to total utter destruction of the economy slowly?
Right. Which is what they've been doing now for 51 years. Right. Slowly. But again, I reference, again, I've been doing this for a dozen years. This side of mine, the tagline, like a book will have a tagline, the title and then the tagline. My tagline's always been, we're preparing for the end of the great Keynesian experiment, right? Where you could just have the system based on debt. And if you can grow fast enough and keep increasing the debt to service your prior debts, that, the thing somehow keeps going. But we're rapidly reaching that point. You've heard people say $1 of new debt only creates 20 cents of GDP growth, that kind of thing that these Keynesian economists say. We're at the point where it gets so exponential that it gets out of control. And maybe the easiest way I've always found to explain this to folks, that are just simply trying to live their lives and prepare for what these eventualities are, is think of like the US budget. I mean, I think most people know here in the US, we got about $30 trillion of outstanding debt. And we're adding to that now at a rate of about 10% a year. But even at $30 trillion, they've run the average interest rate, effective rate on that down to under 2% by the zero interest rate policy. So the line item on the national debt in the budget is about $500 billion to service the existing debt. Well, what if that interest rate doubles?
Yes. Yeah.
Now you got a $1 trillion just to service the debt. What if this, yes, we're going to let rates normalize and go to 5%. Now it's $1.5 trillion. I mean, that's getting to the point in a recession where the interest cost of servicing the debt gets pretty close to what your total revenues are. If revenues fall off. And that's where the whole scheme begins to collapse. And they have to make that choice. And that's just, I mean, that's just the simplest sliver of national debt. What about state, public debt, city debt, municipal debt, private debt, mortgages, all these kind of things. And so it's what amazes me. And I guess maybe it's more just a shared self-interest that CNBC and Bloomberg and the Wall Street sell side people and all the investment banks, they all play along and keep promoting this narrative. Again, I guess probably out of a shared self-interest because it's so obvious that it's not true.
Yes.
That rates are going back to 5%. Everything would absolutely implode if it did.
Yes. Yeah. That the debt becomes totally and utterly unserviceable.
Right.
You've had such exponential growth in debt at such low levels of it that even now at this stage, small increments in that rate are catastrophic. It's why we see, I suppose, each cycle, each credit cycle that we see, as credit goes higher and higher, the ability of central banks to raise interest rates becomes less and less and less each time.
Correct.
So they're highly sensitive to interest rate changes at this stage, and just can't tolerate it. So in that situation, what we've seen over the last while, the one thing that has particularly stood out is the US dollar as an asset. If we look at the dollar index, we look at it against all the major currencies, it's performing well. So it's fulfilling that role of safe haven, you might say, in a world where everything is crashing off. In the situation that you're talking about here, in a return to quantitative easing, a 180-degree turn by the Fed, and this effectively embracing rampant inflation in order to prolong the fallacy of the US economy for longer. Do we start to see a reversal then in the US dollar? And a significant decline from here?
Yes, it will be the dollar's turn in the barrel, right? That's all part of the kind of the fallacy of the markets, if you will, at this point, right? My friend, the Englishman, Ned Naylor Leyland, I don't know if that's somebody you know, money manager. Ned famously coined the term that the futures tail wags the spot dog, right?
Yes.
And the futures market, which is, just these mostly unbacked derivatives, are traded by these computers, which take their trading cues, they're pre-programmed to buy or sell gold futures based off things like movements in the dollar and, the bond market, things like that. And a vast majority of the trading volume every day are these high frequency trading computers. Well, think about how silly, one, just the notion that somehow the physical price is determined through the trading of baseball cards is ridiculous. And that will one day change. But think about how silly it is that if you kind of walk that through to its natural conclusion, what's the dollar index? Dollar index compares the fiat dollar versus these other similarly devaluing fiat currency. For this moment in time, there's kind of a safe haven bid because I don't want to invest in anything because everything bubbles popping. So I'll just, park it in some currency that's going up, whatever. But on a bigger picture, the dollar is going up because the euro is going down. The euro is 57 or 8% weighting in the dollar index. And why is the euro going down? Well, because they're stuck. He's really stuck. And the yen is going down, which is another 10, 12% of the dollar index. And why is that? Because the Bank of Japan is stuck. They're trying to defend their yield curve control policies, and they're sacrificing. Heck, Dave, we just found out back a couple of days ago that in the tick data, the Japanese sold something like $70 billion of treasuries in the month of March.
Wow.
Because they're raising cash to defend the yen. Okay, so all these other currencies are weakening, which gives you the impression by default that the dollar is strengthening.
Of strength. And another way of looking at it is all of these currencies are weakening and the dollar is weakening. It's just weakening at a slower rate than all the other currencies. So respectively, it's strengthening. Right.
So again, the folly of it then is that these machines see the dollar going up and they sell gold futures. Well, wait a second. gold is clearly improving versus all these fiat currency. Just because one is going up a little bit relative to the others should not make a rational carbon-based person, a trader, sell their gold. And nobody's selling any gold. I mean, gosh, the premiums for gold and silver here in the States are just outrageous.
Yeah.
But everybody, these machines trade their futures contracts, and that drives the spot price as well. And so it's such a weird time. I'm confident though, and I mentioned
this is why you're seeing this gold or this precious metals weakness at this moment in time, a large contributing factor to that.
I mean, and yes, and the other thing historically that's a big driver of gold prices, there's a very tight correlation over the decades, is the level of real interest rates, inflation adjusted interest rates. What's remarkable is these machines and your Wall Street guys and the bullion banks and everybody that puts out research on gold, they've decided over the years that real interest rates should be measured not against the current level of inflation and interest rates, but instead inflation expectations. As if expectations are ever right about anything.
Yeah, indeed.
Right? And so now they're trying to tell you that, oh no, real interest rates are positive. What? Wait a second. The 10-year note's at 3% and inflation's at 9%. No, they're positive because 10-year inflation expectations are 3%. Well, wait a second. That's never gonna. And so that's, again, it's like the dollar. That's the folly of the rationale for dumping, these digital gold contracts. And it really is maddening. But it can be, if you're comfortable with the math, if you think for yourself, as most gold people do, then you can kind of see through this. You can recognize it for what it is, and you can use the system against itself by, going to Gold Core and getting yourself some physical metal. I mean, there's no way gold should be $1,800 an ounce, and it will not be $1,800 an ounce going forward, if you want to go a year out, 3 years, 5 years out, whatever. And so use it to your advantage, that you can still afford it when there's really nothing else that you can afford.
I'm going to put you on the spot for a second, Craig.
Sure.
If you were in Jerome Powell's shoes now, what would you be doing?
I would quit my job and go to work for Citadel. Is that a good? That's what. Look, I cannot believe. I was stunned when he announced he was going to go for a second term, and he just got confirmed a couple of days ago. I thought, what an idiot! Why would you? And the only reason I think that he would sign up and do this again for a second term is he believes his press clippings. Yeah. It used to be, and Dave, I'm sure you remember this. I mean, back when I was a stockbroker 30 years ago, the only time you ever heard from the Fed was when a Greenspan would go up to Capitol Hill every 6 months.
Indeed, yeah.
And that was it. And now, if there's an open mic, one of these goons from Cash Carey to Bullard to Evans to Mester, to, you name it, they're going to grab it. And they've all been taught, conditioned, if you want to use a psychological term, to think that they are the masters of the universe, that they control everything. And I think the only reason I can come up with why Powell would want to keep the job for another 4 years is because he believes it, that he's omnipotent, that they can fix this through their little dials and spinners of monetary tools.
He's drinking the Kool-Aid. He's
drinking his own Kool-Aid. Yeah. Because remember when we first started, I mentioned crude oil.
Yeah.
Okay, as we record this, crude's like $112 or $13. It's moving toward its highest daily close since September of 2008. Okay, it's a major problem, not only just in terms of price, but here in the US specifically, we don't have enough refining capacity. And so a choice is being made between making jet fuel, heating oil, gasoline, jet fuel, diesel fuel. Okay, you got one molecule, you can only crack it once. Okay, so all these distillate prices are going through the roof. There are pending shortages and rationing of diesel fuel on the East Coast. Well, what the heck is that going to do for inflation? right? And people are going to freak out, right? When all of a sudden the shelves are bare and all that kind of stuff. Then we've got grains. I mentioned that earlier, soybeans, wheat, corn. They're all at almost all-time highs already because fertilizer costs are through the roof and all that kind of stuff. Corn goes into everything, not high fructose corn syrup and every processed food, but it's a feed for livestock too. So there's no amount of, yes, we're trying to decide between 50 and 75 basis points. It doesn't matter. And what if we get a drought in the US this summer? Okay, so I just think this notion that as masters of the universe, they can fix all of this through their, kind of very minimal tools of playing with the Fed funds rate and stuff like that. Just not going to happen. And then again, ultimately, all the way back to the beginning, they have driven everyone and everything into risk assets. I mean, you think of it, typical insurance company used to buy treasuries and high yield or regular corporate bonds, AAA rated stuff to hedge their risk, and actuarial stuff. They know how many people are going to die and all that kind of stuff. And all of those insurance companies are now in risk assets because they can't make their models work at a 1.5% 10-year note. So, and then they think of the local pension fund, your local pension fund, you've got this where you live, right?
Yeah.
All these pension funds that have these goals, they're trying to make 8% growth a year to cover all these pensioners that they've got to pay for until they die. Well, you can't get 8% in the bond market. So they've all been driven into stocks and high yield bond. If it collapses, it is going to be and they cannot allow it. So they can play these rhetorical games up to a certain point, and then they will absolutely guaranteed 100% have to shift. And when they shift, man, that's going to be the time for the metals to shine again. And it's coming sooner than people think.
And when they shift, they'll have to shift big as well. So as you're saying, like, let's take the Russia-Ukraine war at this moment in time. That's 10% of grain off the market. You can't tackle that by increasing Fed funds rate in the US by 50 basis points. That's not going to do anything for that. That problem is there, and it's about to come through the system.
Right.
It's interesting. I asked you that question about what you'd do if you were in Jerome Powell's shoes, and I've asked the same question of a lot of people, and they all give a similar answer. And the reason is it's not because they don't know what to do, because they don't have the wherewithal to think of a solution. It just seems there is no solution to this.
Right. That's true.
And that's
you've hit the nail on the head. And
that's the simple fact of this, isn't it? And it's a case of this is going to play out, but and how quickly? That's the ultimate question.
You mentioned confidence and the ability to pull this trick through another cycle. On March the 4th, Friday, March the 4th, the yield on the 10-year note closed at 174. Over the weekend of March 5th and 6th is when the U.S. kicked Russia out of SWIFT and seized about $400 billion of their offshore currency reserves. Since then, and that tick data I mentioned earlier displays this. I mean, I'm not just making this up or pulling this out of my rear end. Almost every government around the world has been a net seller of treasuries. Okay. What if, that lesson's been learned? What if you're the Chinese who have the lowest treasury holdings in 10 years and they go, well, now that they've shown their hand, we don't want to be put in that position.
Yeah.
So as rates rise and then as they need to come back down to keep the plate spinning, what if there are no buyers? What if the Fed is the only buyer at that point? Well, now we're talking, it ain't just going to be what was it, $90 billion a month in treasuries that they were buying, or 80 or whatever, 80 billion, what it was from March until recently. It's going to be twice that because, of this debt, the existing debt, the refunding of the current debt, the new spending that's got to come out, and there are no buyers. So, when people say QE on steroids, and you mentioned the war, that's why I bring this up, a lot of things have changed since they pulled this trick, 10 years ago, or even since they pulled this trick 3 years ago. There can be no assurance that all they got to do is, well, we'd like to have rates come back down now, we're going to start QE, that anybody else is going to show up and bid for U.S. treasuries besides the Fed. And at that point, you're into banana republic territory and a loss of confidence. And that's when the bid for precious metals doesn't go away.
Yeah.
And it actually continues and gets stronger.
And one of the reasons it gets stronger is exactly because of that, because those
Yeah.
that would have been buying treasuries in the past as a way to hold their dollar reserves are now saying, how else can I hold my dollar reserves? Well,
Right.
converting them into metal seems the argument for that is an awful lot stronger now than it has been in the past. And we've already seen that happening with Russia.
Right. Right. And, you know, and it comes all the way down to just you and I and everybody listening to us, because we're kind of in the same boat as big institutions or even central bankers. You know, if I've got some money left over at the end of the month because things are humming at my website, I can keep it in dollars, I suppose.
Yeah.
I mean, I haven't noticed yet that even though credit card rates are still 20% and prime rates moving up past 4, I haven't noticed my bank paying me any interest yet.
Anything? Yes, indeed.
How about that? And so at some point you look at it and you go, okay, let's take the case of physical silver. You know, they've beaten silver down here to $21. What's the downside from here? Well, I don't know. The all-in sustaining cost for a lot of miners is $20 plus.
Yeah.
You know, where they're just going to stop. You don't immediately put your minds on care and maintenance, but you at least go, yeah, we're not a charity outfit here. So then the supply falls off. So what's your downside? And maybe the machines run it down. They just keep dumping the futures and the market bifurcates and all this kind of stuff. But what's your upside? I mean, even if it's only $25, that's still 20% up. It would take me what till the year 2500 to make 20% in my checking account at this point, right? So that even at the personal individual level, notwithstanding all of the sound money arguments and everything that else that goes with it, saving in precious metal is a pretty good idea, especially after what the machines have done to prices over the last month.
Indeed, indeed. Before we wrap up here, Craig, can you tell us where our viewers can find out more about what it is that you do?
Well, I've pointed up at this thing a couple of times. I've run this site for about a dozen years. I tell everybody on my site I'm kind of their eyes and ears, so that because everybody's busy, Dave.
Indeed.
I'm sure you got stuff you got to do right after this. And the people on my site, it's a global community of people, diverse backgrounds, politics, but we're all in the same boat, right? About where this ship is headed. But everybody's busy trying to care for their kids and their parents and make a mortgage and, all this kind of stuff. So I sit here and stare at my screen like this all day long, trying to make sense of it all. I write a report in the morning and then record a podcast in the afternoon.